Thank you, Pete. A pleasure to be here with you guys. At first, everyone on the call, Pete described it very, very well. The IC disc is a very, I don't want to call it a well-kept secret because it's not meant to be a secret, but it's a well-kept secret. As everyone knows, the Internal Revenue Code, everyone's favorite book on yourself in your library, of course, is littered with a lot of benefits for us. And as an exporter, the IC disc is one of the best ones for you. So the first question for everyone is, what is an IC disc? Well, it stands for Interest Charged Domestic International Sales Corporation. Now, I'm going to keep this very high level for 15 or 20 minutes and give you some time to take your questions. Moreover, if you have any questions after the presentation, you'll have my contact information. Always feel free to email me or call me anytime. A little bit about our firm. We are an export tax manager. We're CPAs who specialize in international taxation, who then specialize in the IC disc. The IC disc is one of the most complex parts of the Internal Revenue Code, is why there's folks like us in the world. However, for exporters like you guys, it's very simple for you to use. Uh, it's analogous to, let's say, deducting your charitable contributions on your individual tax return. For the exporter, this is a very simple process. Now, with that said, what the IC disc is, the Interest Charged Domestic International Sales Corporation. We're not going to get into detail today on what the interest charge means, but Domestic International Sales Corporation, it was originally acted in 1971 and it was modified in 1984. And in its current form, it's still the statutes written in 1984. What essentially this is, as Pete said very wisely, many other countries in the world, we call it the OECD, or throughout the world, they have ways of incentivizing, and to some degree, a lot of countries subsidize their exports. The United States doesn't subsidize our exports. However, we have the IC disc for an added incentive. So what this does is for a privately held company, it's a tax incentive for U.S. companies who sell products made in the U.S. and sell those products for use outside of the United States, i.e. an exporter. So why I stress this one point here, you do not have to be a manufacturer of a product to take advantage of the IC disc benefit. Moreover, you don't have to be the direct exporter. And there's a slide a few down, which I'm going to go into more detail about that. So you could be, as an exporter, you could be the direct distributor selling your products overseas, or you could be selling your products that you manufacture or distribute through another distributor in the US who then exports your products. So just remember, domestic and export distributors qualify. How does it, how do we get our benefit is the next question I'm sure you guys are thinking. Well, imagine when you get your brokerage statement at the end of the year from Fidelity or whichever brokerage you use, you'll see you get qualified dividends from some of the stocks you own. That's a qualified dividend, as you know, is taxed at a lower rate of tax, similar to a capital gain. What the ICDIS does, it allows you to reclass some or all of your taxable income on those export sales to a qualified dividend at a rate of about 23.8%, as opposed to your ordinary income you pay in your individual tax return of 37%. So for those of you that might have S corps, LLCs, and C corps to a degree, again, I'm going to be very, very simple through this presentation. This works. And in essence, it's a small business incentive because the larger publicly traded corporations cannot take advantage of this. Only privately held enterprises. Now, there's no limit to the size of the disc. I have clients that have $400 or $500 million of export sales. I have clients that have $1 million. I have clients that have 500,000 of export sales. So remember, it's not limited in size, whether you have to be too small or too large. Now, what is this? I'm going to stress this. This is a statutory provision. It's a fancy way of saying it's law, just like deducting your mortgage interest or your charitable contributions. It's not an aggressive tax strategy, and it's not what we call an abusive tax shelter. The IC disc is a separate entity. And one would ask, well, why is this in the code? It seems too good to be true. Don't go through reading the Treasury regulations, but this section here sums it up quite well. They understood this is all form and no substance, but it's here to help exporters. If those of you who spoke to your CPAs about this before, you're going to hear something called, well, the 95% asset receipts test. be very simple about that. What that means, the DISC can only be to help you foster and promote export sales and reclass your income from ordinary income to a qualified dividend. The IC DISC is a separate legal entity that we set up. No one knows it exists except for you, your CPA, and the IRS. That is it. And the DISC can only be used for this purpose of foster and promote export sales. You can't use your DISC to hold real estate, to hold other assets. It can only be used for its purpose.